Hi everyone, I'm Arya and today we are diving into something really exciting. How to create smart, data-driven investment strategies that can help you achieve better returns. Later in this video, we'll be creating a strategy that delivered 301% returns over the last 2 years, and I'll walk you through exactly how you can build it yourself step by step. Whether you are new to investing or a seasoned trader, this guide will show you how to use key metrics, backtesting, and risk management to build a portfolio like a pro. So stick around because by the end of this video, you'll know how to create, test, and implement your own winning strategy using Sharply. Ready to learn how to take your investments to the next level? Let's get started. Creating a dynamic investment strategy might sound complicated at first, but it doesn't have to be. You can either spend hours researching individual stocks and building your strategy manually or take a more streamlined approach by using a tool like Sharply, which simplifies the entire process. So here are the 5 essential steps that you need to follow. The first step is defining your stock universe. Think of this as the pool of stocks you want your strategy to pick from. You could limit your universe to a specific index like the Nifty 50 or focus on sectors you believe in, such as technology or pharmaceuticals. Narrowing down the stock universe is essential because it aligns your portfolio with your personal beliefs and investment goals. For instance, if you are bullish on India's infrastructure growth, you might create a universe of companies involved in construction, energy, and logistics. Once you have defined your stock universe, the next step is to filter stocks using key metrics. These metrics help identify companies that align with your strategy's goals, whether it's finding undervalued stocks, high growth companies, or stable dividend payers. For a value strategy, you might use metrics like the PE ratio or PB ratio to find stocks that are trading below their intrinsic value. Alternatively, for a growth strategy, you could look at metrics like EBITDA growth or revenue growth over the last 5 years. The advantage of using a tool like Sharply is that it allows you to apply multiple metrics at once. For instance, you can combine momentum indicators like the 1-year return with quality metrics such as return on equity to filter only the strongest performers. Once your metrics are set, the next step is to look at the stocks that meet your criteria. This part is crucial because even with a good strategy, the devil is in the details. Not every stock that fits your metrics will be a good investment, so it's important to review the results carefully. For example, a company may have a great ROE but might also carry high debt. That's why tools that allow you to see multiple metrics at once are incredibly helpful. They let you filter out any red flags. From here, you can tweak the metrics if needed. Say adjust the weight of certain metrics or remove stocks that don't meet your standards. The next step is to fine-tune your strategy by setting key parameters like rebalancing frequency, position sizing, and risk management. These parameters determine how your portfolio will behave over time. Let's start with rebalancing. Rebalancing ensures that your portfolio stays aligned with your original strategy. If one stock grows faster than others, rebalancing helps you sell some of the overperformers and reinvest in underperformers to maintain the right balance. Depending on your strategy, you could rebalance monthly, quarterly, or annually. Position sizing is equally important. You need to decide how much of each stock to hold. A good rule of thumb is to avoid putting too much money into any single stock. This helps you spread out your risks. Finally, there's risk management. A well-designed strategy isn't just about making profits. It's also about protecting your capital, setting stop losses, defining maximum drawdowns, and diversifying across multiple sectors are some of the ways you can minimize your downside risk. The final step is to put your strategy into action. Once you have set all the parameters, you can publish the strategy. If you are using a tool like Sharply, you can start with paper trading to test it in real market conditions without putting real money at risk. As your strategy runs, it's essential to monitor its performance and make adjustments along the way. Markets change and sometimes your strategy needs to evolve too. If certain metrics aren't working as expected or a stock no longer fits your thesis, don't hesitate to tweak your strategy. The beauty of using a strategy creation tool is that it removes a lot of guesswork. You focus on the strategy, the tool handles the execution. And with a little patience, your strategy could help you achieve your long-term financial goals. Now that you know the core steps of building an investment strategy, let's dive into an example using Sharpely's advanced screener. This feature allows us to input parameters that automatically filter out companies meeting specific criteria, helping us to create a data-driven portfolio. In this example, we want to build a strategy that targets larger companies with solid price momentum and reasonable valuations. Here's how we set it up using the advanced screener. First, we set the market cap above 500 crores. This ensures that we are focusing only on companies that are large enough to provide stability and liquidity. Smaller companies can be riskier and more volatile, which is why we filter them out. Next, we set the PE ratio to 70. This filter helps us strike a balance between avoiding overvalued stocks and identifying those with reasonable valuation. A high PE ratio could indicate that the stock is overpriced, while a low PE could point to undervaluation. We are aiming for stocks with sustainable growth potential without being excessively expensive. Finally, we add a price momentum score filter, setting it to a range of 70 to 85. This metric identifies companies that are showing strong upward momentum in their stock prices, suggesting that investor sentiment and market trends are working in their favor. In the panel below, we add another condition to enhance our selection. Here, we focus on stocks whose price momentum score was between 50 to 70 20 days ago. This means we are only selecting companies that have shown recent momentum growth from a score of 50 to 70 to 70 to 85. This helps us target companies that are accelerating and catching positive momentum. Momentum-based strategies like this aim to ride the wave of positive market sentiment. They are effective, but it's important to monitor performance regularly since momentum can shift quickly. Once we have applied these filters, Sharpely selects a portfolio of stocks based on a criteria. But how do we know if this strategy is effective? That's where backtesting comes in. The backtest shows how this portfolio would have performed compared to a benchmark index. In this case, the portfolio achieved 301% returns over the test period, while the benchmark returned 40.54%. This demonstrates the power of our momentum-based strategy. We can also see other performance metrics like alpha and Sharpe ratio. The portfolio's alpha, which measures excess return over the benchmark, comes in at 38.18%, highlighting that our strategy not only matched the market's performance but significantly outperformed it. The Sharpe ratio of 1.98 tells us that the strategy generated strong returns relative to its risk. A higher Sharpe ratio indicates that we are being adequately compensated for the volatility we have taken on. Similarly, the Sortino ratio of 2.82 further reassures us that the portfolio's downside risk is well managed. If we dive deeper, the backtest summary shows that the strategy made 109 trades with a win rate of 63.3%. This means that more than half of the trades were profitable, which is a solid outcome for any trading strategy. By reviewing these metrics, you gain valuable insight into how your strategy might perform under real-world conditions. With Sharpely, you can adjust and refine your filters, rebalancing frequency or position sizes if needed, ensuring you always stay aligned with your goals. Once you are satisfied with the results, you can publish your strategy and start trading. If you're not ready to go live, you can begin with paper trading to test it further under real market conditions without any risk. This way, you can monitor the strategy's progress and make any adjustments along the way. Creating a strategy doesn't have to be complicated. By using tools like Sharply, you can streamline the process and focus on making smarter investment decisions with confidence. Well viewers, subscribe to Sharply for more such videos and investment updates.